Jerome Powell has put jobs in the spotlight, period. He was speaking at the European Central Bank panel discussion this morning alongside ECB President Christine Lagarde, and he said something that was really interesting. If labor market unexpectedly weakens, that would also cause us to react. What does that mean? That means that this week's non-farm payroll, which is going to be released at 8:30 a.m. Eastern on Friday, and we will have a bonus session in the Sector Secrets Mastery to cover this. We'll take a look at futures options, strip and strap straddles to trade hot zones pre-market. So we'll do that. But here's the bottom line. This is where, as they say, the rubber meets the road. And the idea is we take a look at what's happening. Here we go, at the CME FedWatch tool. So as we wrap up today, July 2, one thing that I saw hit the headlines frequently was a number of analysts, not that I care what they say, but it is communicated, therefore it is reacted to. We are not expecting any rate cut in July, so don't worry about that. July is going to be a hold. It's been expected to be a hold, and that's that. But it's September 18, that meeting, which continues to increase. Just last week, this was about 57%. Now, I know this is a long way off, right? But remember, the market is an anticipatory machine. What is coming around the corner? What do we expect? Buy the rumor, sell the news means we're going to buy the expectation of a potential quarter point cut. And if we don't get it, obviously there's going to be a sell-off. But even if we do get it, there might be a slight sell-off unless we continue to have high expectations for another rate cut in November and yet another rate cut, a third rate cut for 2024 in December. That is a 2-minute macro breakdown of the world that we're in and why we must remain bullish. But bullish where, right? Not everything is in an uptrend. What is in an uptrend? S&P remains very much an index that it makes sense to buy, but more so than that, I would focus on the NASDAQ and Q. I would focus on the NASDAQ. The reason being is the components, the sectors, the stocks that the S&P shares with the NASDAQ is why it's up. It's not up because of financials. It's not up because of healthcare. It's not necessarily even up because of energy. It's up because of semiconductors, technology, communications, and the recent surge in consumer discretionary like Amazon and Tesla. So one of the trades we put on as we rolled from Q2 to Q3 was a long position in Amazon. Why? Does it have a trend? Not yet. But as this lagging sector, XLY, is playing catch up to the other leading sectors, technology, semiconductors, and communication, Amazon and Tesla are getting a great big boost. So you want to stick with the NASDAQ because right now, arguably, it's firing on all 4 cylinders: consumer discretionary, semiconductors, technology, and communication. So let's talk about a couple stocks within the communication sector. Meta and Google. We want to continue to look for some strength in Meta and Google. I do like Google a little bit better than I like Meta. The trend is a little bit more established here. It's been in a trend since June 21. Apple, we want to continue to keep an eye on Apple. Look, gang, new highs are never bearish. Apple right now, the high on June 12 was 220.20. Today's close was 220.27. While not smashing through that level, I would continue to look for more upside in Apple. Now, tomorrow, Wednesday, the 3rd, is a half trading day for equities. Of course, July 4 is off. But don't think that the equity markets are going to phone in the rest of the week because of the July 4th holiday. Because again, Powell basically said if jobs are amiss, so case in point, if NASDAQ is amiss, if non-farm payroll is amiss, we would see NASDAQ, S&P, technology, communications, consumer discretionary, and probably a whole lot more continue higher. So if we take a look at what's expected right now, take a look. It's expected that the unemployment rate is going to remain the same. If that ticks up, that's going to be bullish. Non-farm payroll is expected to come in at 196,000. right? Now we'll want to check these again before the release on Friday because forecast and consensus can change some. But if that prints less than 196,000, the markets are going to go up, right? Those are going to be your two main headline numbers. Average hourly earnings, while important, may not have the same impact that a tick up in the unemployment rate, which would be a disappointment, and a lower print than 196. Now, the closer we get to that 8:30 a.m. Friday hot zone, we're also going to look at a lot of the consensus. Now, what that means is every single brokerage has their own NFP, and there's also expectations for what NFP could be. So there's sometimes a wide range of expectations. I have seen expectations for the unemployment rate as high as 4.1, where a print of 4.0 would be a miss. So we want to keep in mind that the forecast on an individual site may not necessarily reflect all of the different opinion out there. When we take a look at the kind of crowd, I look at this data. It's close to the old force rank as I've seen. I see expectations as low as 166 for non-farm. So remember, we'd have to print a pretty decent miss for it to be really bullish. But if it is a miss, and rather than a beat, so anything over, say, 200,000 would be considered probably pretty decent, and we may not see a rally. But let's take the flip side. Let's say the market does pull back based on a better than expected jobs outlook. That's going to give us opportunities to buy a dip in NASDAQ, in QQQ, and in other uptrending stocks and sectors. In the premium video, I'm going to get precisely into which stocks and which sectors would be eligible for the buy the dip if non-farm payroll disappoints by being better than expected. I know we've gone down the rabbit hole, but that's the way it is. Bad news is bullish, good news is bearish, and that's what Powell himself has put on the plate as of today for Friday's jobs numbers. We want to look ahead to that. That's the next major thing that we're going to be dealing with. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.